Hi, I'm Peter Rose, founder of Longwood Currency Trading. Why the last trade of the day fails? Why does that always happen? If you're a long position trader, you don't have that problem. You've got other problems. But as a day trader, we tend to take 1 to 3 trades a day, something like that. Sometimes 4 or 5. When you have very volatile conditions and you're really unsure where the blow-off is coming, you might take 10 pips and lose 5, get back on, get another 5, and go from there rather than letting the whole thing run or something like that. But regardless of that, the whole point of being a day trader is to be flat at the end of the day. So you're not taking a trade and holding it. You're experimenting with that current price action to try to get the most squeeze out of the market as you can for your day that's there. Why does it always seem that if we're making multiple trade closed positions a day, that last one that we take doesn't work? It fails. How do you know it's the last one? Because you say, I'm just going to make one more trade. I'm going to try to get another 5 pips out of this. I think I could get another 10 pips out of this. That's the last trade of the day. Not the one where you are trading and stuff and you hit your profit target and you say, okay, I'm done. It's not an after the fact. It's an in-process decision that you make. I'm going to take one more trade because, and as soon as you say that, that's the last trade of the day, and more often than not, it's not going to work. Why not? Because you're not trading then. You're trying to squeeze the market for, I don't know, $100 so that you can go out clubbing, or make your car payment, or whatever you're going to do. Round out the day with an even $300 instead of the $246 that you have. Whatever that reason is, it's not based on what I call the entry analysis stage of the life cycle of a currency position. To me, as a software engineer, 33-year career as a software engineer and 40 years in real estate, the process of trading is encapsulated in the life cycle of a currency position, which is entry analysis, position management, and exit methodology. And so if you're going to take the last trade of the day, you're not doing the entry analysis. You're doing something else. Instead of saying, oh, do I have a valid profit target? Where's my risk? And do I have enough juju, magic, pixie dust to make the distance between here and there? And you're not going through that. You're saying, I'm going to take one more trade because I think I can get 5 more pips out of this. And at the size I'm trading, that's another couple of $100. So instead, that position loses. But because you took that position, look back on your trading. Because you took that position, not through entry analysis, but through some convoluted shit that's going on in your head, you want to buy that new gadget to hook onto your phone, you're going to fall in love with that. It's only 5 more pips. It goes 5 against you. Well, it goes 10 against you. It'll come back because, the market owes me this. I'm just trying to get an even number. I'm trying to get $300 instead of $250. Whatever. And you'll let that go and you'll hit maybe 20 or 30 pip loss before you wake up. I've done them where it's got much worse than 30 or 40 pips. Because I'm not dealing rationally. Look, guys, as soon as you go off the trail, you're going to get bit by the tiger. Don't go in the woods if you don't want to get bit by the tiger. But why do we go off into the woods? Because we think we know what we're doing by following the path. It's too easy. Where's the thrill? Trading isn't for the thrill. It's not for the shits and grins. Trading is to make money, not to extrapolate your craziness into the charts. The last trade of the day is not only the worst trade of the day, but it should never be made. I've made so many of those. And finally one day I realized it's the last trade of the day. And the reason I recognized it is I live in New England, in New Hampshire. And it was during the winter. This is several years ago. And my daughter was going off skiing. I remember the story that she would tell. I don't ski myself, but I know lots of people that do. And they always say most of the injuries that happen on the ski slopes are by the people who take the last run of the day. They're tired, they've been out there all day, it's cold, they're going to meet up with some friends at the lodge and have drinks after the skiing. The sun is nice, the snow is nice, let's just take that one more run for the day. And that's when they are not skiing and paying attention to the skiing. They're taking the last run of the day so that they can then do something else. Their attention and their focus is not on the skiing or the experience of the beauty of the skiing, it's the last run of the day. And I thought about that, and I looked back in my transaction register over the previous couple of years of trading and saw that all of my big losses were last trades of the day. And I fell in love with them, and because I didn't have a solid entry analysis plan that fit into my trading plan, that I was off in the woods. And once you get off in the woods, it's very hard to find your way back. We delude ourselves. So why that last trade of the day fails? It's because you're not using your trading plan. You're doing something else. As soon as you recognize that, I guarantee you, you will improve your trading greatly, your trading results, because the last trade of the day, when it fails, it's a big fail. And if you can avoid the big fails and just take little ones, you're all set. So if you've got a good trading plan, as I do, then you take those short losses and you get out. Once you wander off that disciplined path, 20 pips, 50 pips, 100 pips, you just let it go. It finally gets to a point around the 50 or so pip point where you go, well, I don't care, it'll come back. And that, more often than not, is the result of the last trade of the day. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.